Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, moving forward, if we're expecting a move in either direction, many of you are familiar with either purchasing a straddle or a strangle. Now, if we're looking at buying a straddle, we're essentially buying a call and a put at the same time. Now, we're going to obviously do this on the same pair value, and we're really looking at establishing this strategy if we're not sure which direction the pair is going to go, or that we don't know what way the U.S. dollar is going to go, but we think or we feel that it's going to do something. Now, in this case, a straddle has us buying the same strike, and in the example that I'm going to use, we're going to be looking at the same expiration date. So if we take a look at a straddle on the EUI, so the US dollar versus the euro, we may feel that the pair value is going to make a big move, but we're just not sure which direction it's going to go. So you can see here what I've done is I've essentially established the pair value at being at 82.04, and we think that either the euro is going to continue to drop against the U.S. dollar, or the U.S. dollar is going to continue to strengthen, or we're going to get a reversal. So we don't know, but we want to participate in one way or another. So in this case, what I'm looking at doing is buying one EUI September 82 strike call option, and I'm paying $2.49. That will be to participate in a move to the upside. I'm also at the same time going to buy one September 82 strike put option, and I'm going to pay out $2.12. And if the EUI moves down, then ultimately I'm going to be able to capitalize on that move to the downside. Now you can see the difference here is that I have to pay for two positions here. So I need to see a very significant move either in one direction or the other. And you can see that the cost of this entire position is going to be a combination of our calls and our puts. What this does is it increases our break-even point on the trade. So you can see that in this particular example, I'm going to make money if we get a big move to the downside. I'm going to make money if we get a big move to the upside. But if the underlying security here, the EUI, is range-bound within my time frame, that's when I run the risk of losing my entire position. But where this strategy becomes powerful is ultimately if we have a specific directional bias, but we think in the shorter time frame, and those of you that are members of the Option Source site will know we're taking advantage of this strategy. We can actually just simply choose a shorter expiration date to hedge one side. So in other words, we might be bullish on the EUI and buy the September 82 call options, but to hedge our risk on the downside, we might look to buy the July 82 puts. So we'll put out significantly less capital, and if we get a short-term move to the downside on the EUI, then we've got a hedge in those put options to offset the risk. And once that move takes place, we can sell our put options, lock in the profit, and then we have our call options sitting there ready to make some money from now until the end of September if we happen to see a change in direction. So the main focus of this strategy is really having a non-biased outlook, other than the fact that you assume that there's going to be a big move. The fact is you still want to give yourself time to participate in your main directional bias, but you can again choose a shorter expiration date to hedge the one side. Now, if you're looking to create a strategy that has a lower cost basis, we can create what's referred to as a strangle. Now, a strangle has us buying a call and a put at the same time. We're looking at, of course, the same pair value, and in this example, we're looking at the same expiration. Now, in this case, we're going to look at creating this strategy using different strike prices. Here, we're looking at the same pair value, we're looking at the EUI, but in order to lower our cost basis, we're going to choose strike prices that are slightly out of the money. So we're going to look at buying an 83 call and we're going to look at buying an 81 put. And you can see here that we have two different strike prices that we're participating with, and the challenge here is that we need to see a more, although our cost has lowered significantly, we need to see a greater move in that underlying security to recognize a move to recognize a profit in this position, which means our break-even point is going to be a little higher with this strategy. So again, we lower our cost basis, but we need to see a bigger move in the underlying. Now, of course, you can also choose a shorter expiration date to hedge. So in other words, what we could do is we could still buy an at-the-money call at 83, and we could pay, the $2.50 that they're asking, and we could go in and we could buy a July or August 81 put option and pay the lower cost for that slightly out of the money near-term strike price if we were more inclined to create a position that was more leaning towards more of a move to the upside. Okay, so all we're simply doing is simply widening the strike prices on our calls and our puts to create a strangle. So you can understand the concept. A straddle, we're on top of the strike price, same strike price with the with the call and the put. On a strangle, we're surrounding the underlying security strike price. Okay. Now let's move forward and take a look at generating some creating some strategies to generate cash flow. Now the first approach is to sell a naked call. Now this Andrew just made a comment back when I was talking about a straddle or a strangle, is that we could actually sell those options. Well, this falls in line. We're not going to talk about doing a naked call, selling a naked straddle or a naked strangle, but the principle is still the same. In this case, if we're looking to sell a call option, and I'm looking at the CDD once again, and I might expect that the CDD between now and the third Friday of August, you can see here, is going to be below 108. Well, that means realistically, I feel that those 108 call options are not going to be worth anything by the third Friday of August. So if I simply want to put the time depreciation purely on my side, I can go in and I can in fact sell these 108 strike call options and collect that full premium as the option expires. Now, the challenge here is that I have a limited profit and an unidentifiable risk exposure, but this is a great way to take advantage of a highly volatile market. So in other words, if option premiums are expensive, and I'm very confident that the Canadian dollar is not going to be above 108 by the third Friday of August, I can take advantage of that increase in volatility and that increase in premium, and I can sell those call options. Now, the bottom line is, if we take a look at our profit and loss graph here, the maximum profit that we can make, no matter how low the U.S. dollar trades against the Canadian, is the 102 or the $2 the premium that we've collected. The challenge is that we have an unidentifiable risk exposure anywhere above our break-even point, which in this case is $1 or is 109.02. And the reason why it's 109.02 is because we're going to get to keep the entire premium, and we start to lose as the CDD increases in value above that above the strike price plus the premium that we've collected. But you can see that we in fact have an increased margin requirement because of the fact that we're selling a naked call option. So anytime we sell an option naked, we have to recognize that we're going to have to put up more capital to do so. The broker is going to require you to put up a certain amount of margin to participate. Now, why we would want to take advantage of this is because we might be somebody that doesn't have the time to manage our positions on a day-to-day basis. All we want to do is just generate cash flow on money that we have sitting in our account.
Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.